We are looking at our first session now today, purchase price adjustments and earnouts in M&A. Next slide, please. I am pleased to welcome my colleagues, William Halliday and Patrick Tomlinson. Will is a partner in our corporate section and is based out of our Tyson's office. Will advises companies through all stages of growth. He has a particular focus on guiding business owners, executives, and companies through high stakes strategic transactions, including mergers, acquisitions, and equity offerings. He has advised public and private companies in the technology, life sciences, renewable energy, and government contracting industries. Patrick is a partner based out of our Virginia Beach office and is also in our corporate section. Pat focuses his practice on mergers and acquisitions and other complex business transactions, including leveraged buyouts, carve-out transactions, joint ventures, controlling and minority investments, and other strategic transactions, as well as general corporate matters. He has significant experience representing private equity firms, as well as public and private companies in domestic and cross-border transactions across a broad range of industries. So Will and Pat, take it away.
Thanks so much, Julia. Next slide, please. Okay, well, good morning, everybody. Pat and I are excited to be with you this morning. Pat and I are going to cover three things today. We're going to talk about purchase price adjustments and really the three most important ones: cash, debt, and net working capital. The second topic is going to be earnouts. And we're going to talk about what an earnout is, what the best use cases for earnouts tend to be, pros and cons, and some of the key negotiating points that you'll see come up when you're talking about earnouts. And then we'll close out with our third topic, which is the procedures. It's sort of the plumbing. It's the mechanics of how purchase price adjustments and earnouts occur, how the parties work out the details and the math and the calculations behind those. So those are the three topics, and let's get started. Next slide, please. And we start at the very beginning, which is a very good place to start. Purchase price adjustments. Next slide, please. And we will have our first of three polls. And as Julia, thank you, Julia, did a great job mentioning, please answer these polling questions because this is your attendance verification while you attend today's CLE sessions. So polling question number one: have you been involved in the calculation of the purchase price in an M&A transaction? Oh, let's see. I don't believe the poll is popping up. Bear with us one second. Let's see. Hopefully everybody's seeing the polling pop up where you can answer the question now. A reminder on the question: have you been involved in the calculation of the purchase price in an M&A transaction? Still no poll.
Well, I think the audience can probably see the poll. It looks like about 44% said yes. So we've got a good mix of people who have been involved in the purchase price adjustment and those who this slide and presentation will be super helpful for. So do you want to move to the next slide?
Perfect.
Perfect. All right. So to begin, let's take a look at kind of the basic differences between enterprise value and equity value and how those factor in to the purchase price adjustment. So enterprise value is essentially the operating value of the company to both equity holders and to bond holders, other debt holders. So enterprise value is not impacted by the capital structure of a company or its mix of debt and equity financing. And it allows a buyer to compare various companies and ignore that capital structure. Equity value, on the other hand, is the value that remains after deducting for debt and certain liabilities. So this is the residual value to equity holders. If we think about equity value as like a simple formula, it's up at the top there. Equity value equals enterprise value minus debt plus cash. So that's the difference between enterprise and equity value. Let's see how these, factor into both a public and a private M&A transaction. So in a transaction that involves a public target company, the equity value of the target is pretty well ascertainable given the publicly available information and the fact that market capitalization is thought of as a proxy for equity value. So as a result of this, the purchase price is usually set by the buyer, whether in the LOI or the bid letter as equity value on a per share basis. Since that price is based on equity value, there's no need to bridge between enterprise value and equity value in the purchase agreement. On the other hand, in a transaction that involves a private target company, there's no market capitalization, and the buyer usually doesn't have much, if any, visibility into the balance sheet of that target company. So the price in the bid letter or the letter of intent is usually expressed as enterprise value, and some multiple of an enterprise value based multiple. So think EBITDA, for example. Buyer's proposed enterprise value in that bid letter or LOI, commonly referred to as the headline purchase price, typically assumes a cash-free, debt-free basis, and that there'll be a normal level of working capital delivered at closing. So these assumptions effectively allow a bidder or a buyer to state the equity value or to bid on the equity value, but they do so by stating the enterprise value and then just having all of these assumptions allow for the purchase price adjustment for the balance sheet items to occur after signing the LOI, after signing the bid letter, when they've actually performed the financial due diligence. So that's all to say that some of what is driving a purchase price adjustment in a private transaction is just the underlying need to bridge from enterprise value to equity value. Next slide.
So what are kind of the key things to focus on in terms of the purchase price adjustment? What do they accomplish? And the first thing, this first bullet point, is it adjusts for the capital structure of the target. And so what does that phrase even mean? You could have, let's look at the same two operating business. They're the exact same company. One is heavily leveraged and has a ton of debt on it. The other one has no debt, right? And so as a buyer, you've got to determine what the value of that target is. And enterprise value, right? Calculating the entire value of the enterprise as a whole. What's the true company worth, regardless of how the financing choices made by the target to date? What is the value as a whole? And then, as Pat just walked you through, how can you bridge to what the equity value is? And it enables buyers to get on the same playing field and the same talking points as sellers in terms of how do you get to a true value for the business. And that's what an enterprise value does. And you can make your capital structure decisions largely around cash and debt in the business accordingly. And so if you're a buyer and looking at bullet point number 2, once you've bought the business, you can now appropriately size what your capital structure, how you are going to finance the business going forward. And so maybe you pay nothing but cash for it, right? Cash that you have. And so there is no debt, or maybe you're going to finance it. And you can appropriately size your debt facilities accordingly. You don't have to follow the exact same debt equity mix that the target did before. And lastly, in terms of the working capital, you've got to get to a normalized working capital, right? What level of working capital is normal and sufficient for that business? And having a working capital adjustment uh, gives the buyer that correct amount or normalized amount of working capital going forward, and it uh, allows for value protection on both sides, right? So that a buyer isn't harmed if working capital doesn't go its way right before closing, or a seller getting harmed if working capital doesn't go its way. So let's look at a few examples, and you see in the third bullet point there, preventing delays in payments, right? So it wouldn't be right if a seller just stopped paying its accounts payable, right? We're just not going to pay suppliers. We'll let the buyer handle that once they own the company, right? And so your accounts payable, right, your liabilities is gonna skyrocket. But if you have an adjustment where you've got a normal target working capital, that's going to get worked out. That type of game won't ultimately benefit the seller. Same with sort of put the other way. Perhaps the seller tries to collect a bunch of accounts receivable just before closing, and then as soon as the buyer buys it, it has practically no accounts receivable. Well, that's worked out by comparing it to a normal working capital target. And so there's ways to protect value, and that works both ways, right? We'll talk more about what working capital and really get into the definition there, but uh, how to protect that definition relative to what a normal basis is for working capital for that particular business. Next slide, please. So let's look at some prevalence, some numbers as to how common these are, and the answer is quite common. These numbers are coming from a great provider of deal statistics, SRS Acquium, and you can see here 5 years of private company M&A data, and north of 90% of private company deals include purchase price adjustments. There's a delineation between the green and the navy blue between where specifically those adjustments are housed in the purchase agreement, whether in the sort of the front half or the back half. But that's much less important. But you're seeing a substantial majority, north of 90%, including these purchase price adjustments. And so an important topic, and one that's frankly top of mind for buyers and sellers, because these are direct purchase price impacts from these discussions. Next slide, please.
Thanks, Will. So now that we know how prevalent the purchase price adjustments are, let's look at kind of the metrics or the purchase price components that we frequently see. So this is, again, a sampling of deals by SRS Acquium over the last 3 years, all private deals that include purchase price adjustments for either cash, debt, working capital, or some other bespoke deal-specific metric, so not transaction expenses. As you can see, a vast majority of these deals include an adjustment for cash, debt, and working capital. And if we just focus on the 2024 deals that were sampled that included a purchase price adjustment, almost all, 98% of those deals included an adjustment based on more than one metric. Next slide. All right, so before we walk through kind of each type of adjustment in detail, let's look at how a purchase price is typically defined in the purchase agreement. For purposes of this, we're ignoring other deducts for transaction expenses, escrows, and other items. So we start with our enterprise value. That's kind of our base purchase price. From there, we add cash. That's the cash adjustment. Next, we deduct for debt. That's the debt adjustment. And then lastly, there's either an addition or deduction for the working capital adjustment, which is based on how much working capital at closing deviates from that target working capital amount that Will alluded to and we'll talk more about later in the deck. So as you can see from this, the purchase price definition basically mirrors that simplified equity value formula that we talked about. And it also addresses all of the assumptions underlying buyer's valuation. So debt-free, cash-free, normalized level of working capital. But of course, the purchase price components are subject to customization, and there's variation across deals. whether that's based on transaction structure or just the reality of the target's business. So for example, if a transaction structured as an asset sale and there's no sale of equity interest of a subsidiary, so no purchase entity, you really don't need a cash or debt adjustment to the purchase price. Cash is treated as an excluded asset. It's retained by the seller, and debt is treated as an excluded liability, again, retained by the seller. You might have some type of payoff at closing where a portion of the proceeds otherwise payable to the seller is used to pay off any debt from third parties that's secured by a lien on those purchase assets. But that's more of a function of releasing the liens and not an adjustment per se. Next slide.
Let's start with the first of our three primary purchase price adjustments, and that is cash. And you're thinking, well, cash is simple. Cash is cash. Not so fast, my friend, in the words of our good friend Lee Corso. Cash is regularly defined. It has in many cases has a somewhat lengthy description in a purchase agreement because it's more complicated than you might think. So as we've talked about cash, these transactions tend to be done when you're buying a business, done on a debt-free, cash-free basis, right? So cash is not going to be included as part of the proceeds in terms of the transaction price. It's going to be deducted for any cash balance there. The customary components of cash. Cash is the amount sitting in your checking account, but it also includes in the second bullet point there marketable securities. It tends to, right? And that has to be set forth, right? You got to work through these things in the purchase agreement. But things like marketable securities, stock and bonds, short-term investments, maybe it's money market funds or other types of treasury bills or treasury notes, any type of thing that is readily convertible to cash, sort of all intents and purposes, instantaneously converted into cash. There are also exclusions from cash or things that don't work quite like you think cash would work. Restricted cash comes to mind. An example of restricted cash is you've got a loan agreement with a bank, and that bank requires you at all times to have $100,000 in a checking account with that bank. It's just a mandatory part of getting a loan from that bank. So you have $100,000 in your bank account, but you can't use it at all. It's there, frankly, as just security for the lender. It's restricted cash, and so it's not functioning the same way that normal cash is, which can be used to pay for goods and services. Trapped cash comes to mind. If you happen to be a multinational company, common example are foreign exchange controls. If you've got cash that's overseas, that you just can't or are limited in some way, shape, or form in terms of moving that cash out of that bank account or out of that country as a whole. The three primary purchase price adjustments, cash, debt, and net working capital, you've got to make sure because cash is a current asset. We'll talk about that more when we talk about net working capital. But you got to make sure you're not double counting and including, if you're going to have a cash adjustment, that you're not including cash in your net working capital definition. Otherwise, you're going to double count and the math is going to get thrown off. And so cash tends to be excluded from the net working capital definition because it's handled by itself as a standalone purchase price adjustment. Next slide.
All right, so the next adjustment is debt. So remember, in a private M&A deal, it's typically priced on a debt-free basis. That doesn't mean that there isn't going to be any debt at closing. It just means that if there is debt, there's a dollar for dollar deduction from the enterprise value as part of the purchase price adjustment. So purchase agreements usually include a very fulsome definition of debt, kind of beyond what we think of as debt for borrowed money, like loans from third parties. So we've listed a few of those customary debt-like items on the left-hand side of that chart, and then a few of the customary exclusions from debt on the right-hand side. Those exclusions really are just clarifying carve-outs. So Again, you don't want to double count. So if a liability is treated as a current liability in working capital, it shouldn't be included in debt as well. Really, the key takeaway here, though, is that a buyer will want to treat as many items as debt as possible. So even items that may not be conventionally viewed as debt, again, because of that dollar for dollar deduction to the purchase price upfront at closing. For the opposite reason, seller clearly wants to limit the items included in debt. And it can do so by trying to argue that a liability is better treated as a current liability in working capital. What that allows the seller to do is potentially take advantage of the fact that the working capital adjustment is keyed off of that target working capital amount. So there's not necessarily a dollar for dollar adjustment to the purchase price. I mean, of course, a savvy buyer is just going to say, well, let's set the target for that specific item as 0. And then they effectively have that dollar for dollar adjustment and you're back in the same place. But it happens sometimes. The other way a target might push back on this is just to say that the liability is not known or quantifiable at closing. So it shouldn't be treated as debt where there's that upfront deduct to the purchase price, but instead the buyer should just rely on its indemnification rights in the purchase agreement to the extent there are, and can just get indemnified if and when those liabilities arise post-closing. Next slide.
Our third primary purchase price adjustment, net working capital adjustment. As we've previewed before, businesses tend to be valued with what's called a normalized level of working capital. And depending on how the company performs in the months and weeks leading up to closing, there could be a positive or negative adjustment based on how actual working capital of the business at closing ends up. And you compare that number to the normalized working capital target, and you can make a corresponding purchase price adjustment, which, as Pat noted before, could be positive or negative depending on how the math shakes out. So what is net working capital? It's a accounting determination, and it is defined by 2 accounting terms: current assets and current liabilities. Current assets are assets that are convertible into cash within 1 year. 1 year is the marker delineating short and long-term assets and liabilities on a balance sheet. And so current assets are assets that can become cash within 1 year. As I mentioned a couple slides ago, because cash tends to be a standalone purchase price adjustment, like debt, those tend to work separately, that net working capital excludes cash, even though cash is a current asset. Examples of current assets that are included or tend to be included in net working capital definitions are things like accounts receivable, right? So an amount owed by your customers, prepaid expenses. You've prepaid rent. Maybe you've prepaid it for the month. Maybe you've prepaid it for the year. If it's shorter than 1 year in terms of the business's usage of it, it's a current asset. Inventory is a current asset. So these are just some of the common current assets that get counted in a working capital definition. Current liabilities is the inverse. These are short-term obligations or obligations that are owed and due within 1 year. And again, just like cash and current assets, you tend to exclude debt, right? Because you have a separate purchase price adjustment for debt. So examples of current liabilities are things like accounts payable, what you owe your suppliers, deferred revenue, which is a liability item. If a customer has paid you before you've provided your goods or services to that customer, or accrued expenses. You do payroll every 2 weeks, but every day that amount accrues, and so you've got a short-term obligation prior to that payroll running for wages that are owed, short-term obligation. So net working capital is current assets minus current liabilities, and whatever that amount is. And that's how net working capital is calculated. Next slide, please.
Perfect. Thanks, Will. So in an M&A context, we should really be thinking about working capital as like a contractual construct. So we'll just step through kind of the basic principles. But again, it's highly customizable. So essentially what happens is you arrive at, or you calculate a reporting working capital of the target based on those principles. And then there's usually certain adjustments to that amount to arrive at the actual working capital in accordance with the purchase agreement. So those two categories, or the kind of customary categories, are definitional adjustments, which kind of, as the name implies, they're just adjustments to reflect the actual definitions in the purchase agreement. So to use kind of our current, or our continuing example of cash, if there's a separate cash adjustment, you're going to need to back out cash from working capital, otherwise it gets double counted. The next kind of category of adjustments is diligence adjustments. This is just adjustments based on buyer's financial diligence, and can include other kind of normalizing adjustments. So, for example, the parties may need to adjust to report working capital that accounts for customary year-end adjustments. All right, so let's turn now to kind of how the working capital adjustment itself works. As we alluded to earlier, the parties typically negotiate a target working capital amount, commonly referred to as a PEG. That is usually based on an average working capital over some historic period. So, for example, trailing 12 months. And the target is really just intended to approximate what a normal level of working capital will be at closing. And then from there, the working capital adjustment is essentially just how much the actual working capital at closing deviates from the target working capital amount. So it can be both a positive or a negative adjustment. And this slide at the bottom here just shows two examples of this. So scenario one, closing net working capital is in excess of the target. So there's an upward purchase price adjustment in an equivalent amount. And then in scenario two, the closing working capital comes in under the target. So there's a downward purchase price adjustment kind of in buyer's favor for $1 million. Next slide. All right. So now we're going to turn to post-closing adjustments in the form of earnouts. Next slide, please. And we have our second polling question, which is, have you been involved in an M&A transaction that included an earnout? And we'll give folks a minute to respond. It seems like we might be having some technical difficulties with the poll. So the answers are really just yes or no, and just record those for now. And I think our marketing team will be reaching out to those who have flagged that they're having issues with that.
Yes, if the poll doesn't pop up for you guys, then you can open it in a pop-up window on the bottom of your toolbar in your Zoom window. You should see a icon on the bottom toolbar that says polls and quizzes, and if you click on that, it should pop up that way. If you are still having issues with that, then you can email your responses in, and we are working on making sure that we get that resolved before the next session. So we'll have an update for you if needed before then.
Thanks, Julia. All right, let's just give everyone a few more seconds here to finish up that polling question. All right, so it looks like there, at least for the folks who have access to the poll, there's a 50-50 split here on folks who have been involved in a transaction that includes an earnout. All right, next slide.
What is an earnout? So we've mentioned an earnout, but what is it? Let's start with the definition. It is contingent purchase price that is paid whether depending on a target achieving certain metrics, and those metrics could be financial or operating metrics over a period of time. So it's contingent purchase price based on how a target performs following the closing. And let's look at again some deal statistics again from SRS Acquium. Looking back on the left-hand side of your screen, looking back over 5 years, an uptrend in terms of the number or percentage of deals, including an earnout, but ranging between 15% and 33%. So a minority of deals, but a meaningful number. What are the most common earnout metrics? How do you measure an earnout? What do you base it on? By far and away, and if you're looking at the right-hand side of your screen, again from SRS Acquium, the most common earnout metric is revenue. And we'll talk about maybe why that is a little bit later. Followed by some sort of earnings-based metric. Could be anything that's earnings-based, EBIT or EBITDA or net income, but that coming in at a much lower percentage. And then lastly, just a catch-all category, other, and that can be any number of things, right? An earnout is a contractual agreement. It can be designed as the parties like, which makes it an infinite number of choices that you can have. But some common ones are volume of sales, if not revenue based, uh, launching a product, maybe obtaining a regulatory license. It's a somewhat common one in sort of regulated fields. Life sciences fields come to mind in terms of FDA licensing. So the divestiture of assets can be any number of operational or other triggers that can be what an earnout is based on. Next slide.
All right, so let's talk about some of the reasons parties might want to use an earnout and some of the reasons they might want to avoid using an earnout. So starting with the advantages, earnouts can help bridge valuation gaps between the parties. So a buyer doesn't want to overpay for a business, and a seller certainly doesn't want to be underpaid. And an earnout can help solve this by conditioning kind of the further purchase price payments on the occurrence of that future event, so that post-closing event. In doing so, a earnout can increase deal certainty, both because it alleviates that and bridges that valuation gap, but also because the parties don't have to condition closing on that future event. So you can just bifurcate the purchase price, have a closing purchase price, and then any further purchase price post-closing if that contingent event occurs. Earnouts are also beneficial to the buyer in that they help incentivize sellers who might remain as part of management of the target company post-closing. Essentially, you're just focusing those employees on achieving that related earnout metric and remaining with the company at least through the earnout period. So then turning to disadvantages. So we just talked about how earnouts are intended to help bridge that valuation gap, but because an earnout is inherently based on a contingent event that may or may not occur, there's some difficulty in kind of valuing the earnout. And it's not uncommon for parties to kind of overvalue an earnout pre-closing by kind of overestimating the likelihood of achieving the earnout threshold, or perhaps just as a function of not fully understanding kind of the complexities of the earnout and the payment mechanics. A disadvantage for seller is that the earnouts are inherently risky because the buyer will control the very business that the seller is relying on for the earnout. You can negotiate certain restrictions on the buyer's actions post-closing, and we'll talk about those a bit more. But regardless, the earnout is going to be subject to the actions of the buyer post-closing. And then lastly, earnouts are often the subject of disputes. That's because of the complexity of the underlying provisions. It's because of that control issue we just discussed. And it's also because of the related information asymmetry. Buyer's always going to have more information than seller, likely even more information than seller, even if seller is involved in the management of the go-forward entity post-closing. Next slide.
What are some of the key negotiating points to keep in mind when an earnout is potentially on the table for a merger or acquisition? First, let's talk about measurement. You've got to choose a metric. What is going to trigger the achievement of the earnout, and how is that calculated? As you remember from the deal study, revenue is the primary one, the one that's used most commonly. But that alone has its measurement difficulties, I'll say. So revenue, who makes a sale? Let's imagine a company, a cupcake company that makes delicious cupcakes, and they want to buy a tractor trailer company. It can be simple enough, right? Your cupcake sales team probably doesn't have too many interactions with the tractor trailer customers and suppliers and vendors out in the world. And so when the tractor trailer sales folks contact a lead and start their sales cycle, it's pretty simple enough that the new tractor trailer target had those contacts and made the sale and generated that revenue. Except that's not the kind of typical deal that we see. More often, we have a cupcake company that buys other cupcake companies. And so now you've got a sales force that was with the buyer and a new sales force that's been brought in, perhaps as a division, maybe still as a standalone subsidiary. And how do you track your sales? How do you make sure that the leads came in and are being calculated and appropriately assigned to the correct division? And so even with revenue, you have very sort of real operational and record keeping problems to track when you get into an earnout. And so let's look at EBITDA or any type, frankly, of earnings before interest, taxes, depreciation, and amortization, common metric looked at in deals. It's an earnings-based metric. And so you've got a buyer, it acquires a target, and the buyer has its management team in place. It has overhead, it has office space, it has HR functionality, it has all types of operational and administrative and overhead expenses. And some of those are should be allocated to the target and the employees that come in through the target because they're sharing in that benefit, even as simple as office space sharing. You got to make sure that those expenses are appropriately allocated and fairly so, particularly with management time and other maybe office leases. Easy enough to track. You can divvy up you got this many cubicles and they're using that. You've got your square footage rate, but there are squishier items like management time and how much time a target is taking of the buyer's brain power and manpower. And you've got to allocate expenses accordingly. And that's something that you got to think through and document to avoid disputes down the road on earnouts for earnings-based earnouts. What about bolt-on acquisitions? What if you acquire a target and then that target turns around and then does M&A activity of its own? It just continually buys new companies. That's going to add revenue, or that's going to add expenses into the business, the target business. And so how is that going to be tracked in your earnout for that the original target before it started acquiring all these bolt-on targets? So the tracking mechanism in an earnout is something to be very, very mindful of. And you can't it's easier with a revenue metric, right? Because there's just frankly fewer moving parts. In an earnings-based earnout, you have to do revenue as well as your expenses, right? So you're just adding in variables that have to be tracked. And so measurement, and particularly over a period of time, which takes us to the second bullet point, length and payment. Common earnout lengths are between 1 and 3 years. That would capture definitely a big size of the earnout pool would fall in 1 to 3 years. I've heard another lawyer mention to me that he had a 7-year earnout, and he did not recommend that. And nor does that, I think, would come as a surprise. I mean, it's 7 years is such a long time to plan for and you've got to put on your Nostradamus cap and you're trying to predict the future and control as many variables as possible. So the shorter amount of time that you have to do that over, the better. Earnouts can be broken up. You'll see incremental payments versus single payment at end of an earnout period. And when is the earnout going to be paid, and how are those metrics going to be calculated? And once you pay out that earnout, maybe it's incremental after 1 year, but you've got a 3-year earnout. The target crushes it, right? They greatly exceed the earnout in the first year. They earn that, and then they fall apart, right? And they don't achieve it. Is there a clawback mechanism? Perhaps, maybe not. Maybe they keep it, right? And so you comparing the potentially incremental payouts to the aggregate over the life cycle of the entire length of the earnout is something to take a look at. Maybe they're caps or minimums. An earnout can't exceed blank, or even if the target doesn't do well, maybe there is some level of minimum payment. What happens on a change of control? The last bullet point here. Maybe a target tries to write in and include in the contract that the earnout accelerates, right? It's paid out. The remaining expected amount of the cash flow gets paid out at the closing of the change of control transaction. Or maybe it's mandatory that the buyer of the original buyer needs to assume the earnout obligations, and they stay in place and then can still be earned over time. So some negotiating points. Next slide, on to you, Pat.
Yeah, thanks, Will. So as mentioned earlier, there's that inherent risk for sellers with respect to an earnout because the buyer is going to control the business post-closing. So chief among these concerns is the concern that buyers' actions are going to be designed to avoid or reduce payment of the earnout. And operating covenants are often negotiated to try and alleviate as best as possible some of these concerns. So operating covenants can be affirmative covenants, like the broad covenant to operate in good faith during the earnout period. They can also be framed as negative covenants. So that second sub bullet there, prohibiting actions and decisions that are solely or primarily intended to reduce the earnout. This can be through diverting revenue to another buyer entity or to another line of business, or disproportionately allocating expenses to the company, kind of what Will had already talked about. So, and then that last sub bullet there, this is really just designed to alleviate concerns with the information asymmetry between buyer and seller. So seller can require that buyer maintain separate books and records so that it can independently verify whether the earnout threshold has been met, and then the calculation of the earnout payment. And then relatedly, sellers will often negotiate, and it's pretty typical to have audit and dispute rights with respect to the buyer's calculations. So buyer will have to deliver a statement setting forth kind of whether the earnout threshold has been met, and then the related payment, and then seller has the right to dispute those calculations. And then this last point, as a key negotiation point, is really related to seller's right to the earnout vis-a-vis the rights of other kind of more senior creditors of buyer. Typically, seller's right to the earnout is going to be subordinate to the rights of the senior lenders of the buyer. And because of this, the buyer is not going to want to, or is going to want to condition payment of the earnout payment on there not being an event of default under its senior loan documents, or that the earnout payment itself doesn't create an event of default under its senior loan documents. And in recent years, this has become kind of a frequent point in the deals that we're involved in, and one that buyers are typically pretty firm about in their position. So there are ways to kind of make it more palatable for the seller. For example, you can try and add some punitive interest to the extent the earnout payment otherwise payable isn't paid because of one of these restrictions under the senior loan documents. But we're starting to see this pop up more and more often. And again, it's language that the seller often has to accept. Next slide.
Related procedures. This is our third topic, and we've combined it because you'll see in the next few slides that the procedures are very common between purchase price adjustments and earnouts. Next slide, please. given a little technical difficulty here, everybody's favorite moment, polling question number 3. Please don't worry. I know we've heard a lot from a lot of you about problem accessing the polling question at the bottom. And so we know you're here because you've sent us questions or comments to that effect. But for those, I think many of you do have access. Have you been involved in a dispute over the purchase price adjustment in an M&A transaction? Yes or no? Have you been involved in a dispute over the purchase price adjustment in an M&A transaction? I'm seeing a new template or format for the poll pop up on my screen. I hope you're seeing the same thing on your end. And we're hearing from many of you via the comments that you're not, but we know you're here. So it's great. Let's see, 30 seconds left for those that do have access. 30 seconds left. Please go ahead and submit your answer to polling question number 3. I got a note that it worked in all caps with an exclamation point, and that is music to our ears. Okay, yes comes in at 32%, no at 68%. So good. Then I think let's jump into it. We can cover it for you. So for when you do, right? When this comes up, you'll be ready to roll. Next slide. Over to you, Pat.
Perfect. All right, so here we have an illustrative timeline of the purchase price adjustment. So let's start on the left-hand side in the pre-closing period. So usually 3 to 5 days prior to the closing, the seller is required to deliver an estimated closing statement. That statement sets forth its good faith calculations or estimates of each of the purchase price components and then the resulting estimated purchase price. From there, we go to this event, the closing date in orange at the top there. And at the closing date, the buyer will pay the estimated purchase price of that purchase price based on the estimated closing statement. Following the closing, usually 60 to 90 days, but even upwards of 120 days, the buyer will be required to deliver a post-closing statement. And that post-closing statement sets forth the proposed purchase price components and then the resulting proposed final purchase price. Once that post-closing statement is delivered, the seller will have a period of time to review and object. The duration of that period, kind of as a general rule, is half the period that the buyer had to deliver the post-closing statement. If a seller fails to timely deliver an objection notice, it's deemed to have accepted the post-closing statement and the proposed final purchase price in that post-closing statement. But let's assume that the seller does object. It delivers an objection notice to the buyer. So after that, usually about for 15 or 30 days, the parties will work in good faith to try and resolve any objections, any disputed items. Any resolved matters by the parties in writing will be final and binding on them. And then any remaining unresolved items will get kicked to an independent accountant. And the independent accountant, at least under the purchase agreement, will usually have about 15 or 30 days to finally determine those unresolved items. The final determination by the accountant is delivered in a written statement to the parties and is final and binding, subject to kind of some certain exceptions. So once the purchase price has been finally determined and the resulting purchase price adjustment, the adjustment is paid. Usually that occurs 5 to 10 business days following that final determination. And it can be paid directly by one of the applicable parties, or to the extent that the deal includes an adjustment escrow, it can be paid in the event of a downward adjustment in buyer's favor by a release of that adjustment escrow.
In fact, a couple of things I'd add in here, and I think the first two are sort of themes that run throughout this timeline. If particularly for sellers, if you're a seller, it's critical that you have access to the books and records throughout this time period, right? You've sold the business, the buyer owns it, but you've got this 90, 120, 180-day process ahead of you where there's going to potentially be some back and forth in terms of how these numbers are calculated. And so getting access to the books and records of your old company, now owned by the buyer, is critical, right? And so spelling that out, access to books and records in the purchase agreement is an important note. Pat also mentioned the independent accountant, which is the person who it's frequently or firm who it's frequently kicked over to make these determinations, be an expert, put on their expert hat and make these determinations. You got to split their fees. Unfortunately, they don't come free. Two of probably the most common ways to handle it are 50-50 or doing a good job and allocating proportionally, right? So whoever comes closest bears a smaller proportion of the fees, and whoever was off more in their calculations bears a greater proportion of the independent accountant's fees. And this timeline is set up for purchase price adjustments, cash, debt, and primarily net working capital. Net working capital is the much more complicated to calculate and track compared to cash and debt, though they're all part and parcel of this purchase price adjustment calculation and true up. The earnout functions the same. The plumbing and the logistics of it function the same. Make an estimate, have a true up, and if there's disagreement, talk it out, or if not, kick it over to an accountant to make some judgment calls. The timeline for an earnout just tends to be longer, right? This is 60, 90, 180 days. Earnouts tend to go for, as I mentioned, 1 to 3 years, and then you do your true ups. And maybe that's on a yearly basis as earnouts are earned, or maybe it's one payment at the end of the earnout period as a whole. But the timeline and mechanics functioning very similarly. Next slide, please.
Right. So another procedural point and a heavily negotiated point with respect to the purchase price adjustment is the accounting methodology or accounting principles used to calculate the various components of the purchase price. So a buyer will typically want the accounting methodology to be GAAP consistently applied. You might have heard this, or it's commonly referred to as a GAAP override because it does just that. It overrides any kind of historic deviations from GAAP that the seller might have used. The seller, on the other hand, as I just mentioned, wants to use the accounting principles that it did to prepare the historic financial statements. Based on this chart, which again is from SRS Acquium, 30% of the sample of private transactions in both 2024 and 2023 had an accounting methodology based on GAAP consistent with the target's past practice. And then around 42% of the sampled private transactions, that's that aggregated percentage that sits above the 2023 and 2024 bars. Those included some specified methodology, including setting forth kind of the deviations from GAAP on a schedule. And then oftentimes, if there is a schedule, it will clarify kind of the precedents that each of those items have in the event of a conflict or inconsistency. So kind of the interplay between GAAP, the historical practices of the target company, and then the specified principles set forth on that schedule. Next slide.
Sources of recovery. So you're a buyer, you just bought a business, and it turns out there's massive debt on it, right? And so there is a negative adjustment to the purchase price. How do you get those funds? How do you get the correct purchase price, which is what was supposed to be on a cash-free, debt-free basis? And so that's what sources of recovery means. How are you going to be made whole? How are you going to catch up on what the accurate purchase price is? One common way, and you'll see in the statistics here, it's quite common, It is north of 70% or more in the last 4 years. Again, of private transactions from the same notable deal studies. And it is using a purchase price adjustment escrow. And so that's a specific delineated escrow that tends to be separate and in addition to an indemnification escrow. And so purchase price adjustment escrow is really there to protect against the first three things we talked about in purchase price adjustments: cash adjustment, debt adjustment, and net working capital adjustment. It's a delineated escrow so that the money is there in case the calculations are off, and it can be a source of recovery. So as you'll see, again, as I mentioned, 70% or more. And what are the sort of teal green line is the percentage of the overall transaction value that the purchase price adjustment escrow is. And so it's small, right? Hopefully these calculations are accurate enough on the front end, but it's 1% or less of the overall aggregate transaction proceeds that are being placed into a purchase price adjustment escrow to serve as a source of recovery if things turn inaccurate. Next slide.
All right, so kind of in addition to that adjustment escrow that Will just discussed, it's fairly typical for a buyer to have direct recourse against the seller in the event of a downward adjustment to the purchase price. So that can be in a deal where there just isn't an adjustment escrow. So the sole source, the initial source, is going directly against the sellers, or it can be to the extent that that downward purchase price adjustment exceeds the adjustment escrow amount, in which case the buyer's recourse against the sellers would be for just the excess amount above the adjustment escrow. In a transaction that includes a separate indemnity escrow, buyer might have the right to seek recovery through a release of funds from that escrow account. When this is the case, it's usually as a secondary source of recovery. So in a deal where there's both an indemnity escrow and an adjustment escrow, and the adjustment escrow has been fully exhausted, and because the downward adjustment amount is in excess of that, then they can go against the indemnity escrow. Of course, a buyer probably is hesitant to do this, probably wants to preserve that indemnity escrow for indemnity claims, but it is sometimes seen as a source of recovery. Next is a cap. So the parties can negotiate a cap on the adjustment amount. The cap can either be a one-way cap, so in the event of a downward adjustment in buyer's favor, but typically if introduced in a deal, the buyer will want it to be reciprocal so that the cap applies both to downward and upward purchase price adjustments. If we just use the adjustment escrow amount as an example, so this is a way to cap the downward adjustment, and it's intended to avoid the sellers having to go out of pocket for any excess amount. So buyer's sole recourse is against the adjustment escrow, and there's no liability for any excess amount. Of course, there's ways to kind of get around this if you're a buyer besides just rejecting it. Like Will said, that the typical percentage of an adjustment escrow vis-a-vis the transaction value is less than 1%. But of course, if there's a cap, you can always increase kind of the adjustment escrow amount to give yourself a little bit more latitude. The pie chart on the right here is just shows the various caps used in sample deals, I think from 2023, all of which included a purchase price adjustment. So as you can see, 36% of the deals included a cap set at the adjustment escrow amount, but notably, all the deals included some form of a cap. Next slide.
Well, Pat, it looks like we have time for a few questions. And for the audience, if you have not done so already, please take a moment, submit any questions that you may have by using the Q&A feature at the bottom of your screen. Pat, first one, this one looks like it's for you. What's the role of outside counsel in the purchase price adjustment, either pre or post closing?
Yeah, that's a really good question. So there's a tendency for counsel to kind of see the purchase price adjustments, the purchase price components, as purely accounting terms, and kind of defer to the accountants. I mean, in some regards, that's exactly what we need to do. Liaise with the accounting function of the client, or the accountants that they've engaged with respect to the transaction. But at the end of the day, as a lawyer, we're the ones memorializing the purchase agreement, the deal between the parties, and need to make sure that kind of the underlying themes brought to our attention by the accountants or the clients are actually reflected in the purchase agreement itself. Especially since we kind of understand the interplay between these concepts from a legal perspective. And then I think there was a post-closing component to that question. So for post-closing, good practice is just when the deal closes, you set calendar reminders, a couple weeks or a month prior to when buyer has to deliver the post-closing statement. If you're on the buy side, that allows you to reach out to your client and say, hey, this is coming up. Has this been put together? How can we help? If you're sell side, it flags to the client that this is forthcoming, and that you can be of assistance if needed when the post-closing statement is delivered, if there's a dispute, or with respect to kind of releasing the related adjustment escrow. So good question. All right, looking here, it looks like there's one on earnouts as well. Will, I'll throw this one to you. Would you recommend an earnout to a client? And if so, what factors should they consider before deciding on whether to include an earnout?
Sure. I think question number one is there a business need for it? What is the problem that an earnout can solve? And so we talked about some of the common problems that earnouts are very good at solving. Things like a valuation gap. A buyer is talking to a target. The buyer thinks the business is worth 8 million. The target thinks its business is worth 10 million. You have a valuation gap. An earnout could solve that gap, right? That a buyer maybe says, okay, well, I still think it's worth 8 million. I could maybe get to 10 million, so an additional 2 million, if the company performs well and meets certain delineated targets, right? And earns its way to 10 million. And maybe a target can agree to those terms, right? That it could agree to 10 million with 2 million of it being an earnout, so long as it hits the appropriate and agreed upon metrics. And so that's a problem that an earnout can solve. You don't want to just, I think probably the feedback I would give is you don't want to just randomly or willy-nilly use earnouts. Earnouts are complicated enough, and but they're very helpful and useful for certain use cases like a valuation gap. Or maybe the buyer wants to incentivize the target to grow and achieve certain metrics. So maybe there's not a valuation gap, but the buyer says, great, we're going to buy you. And here, let's put in an earnout because we want that target. We want the management team at the target in particular, and the sellers, the owners of that business who would stay on in this case, to achieve certain metrics, right? To grow EBITDA from X to Y. And an earnout is a terrific tool for doing that. And so when an earnout can solve a business use case, awesome, great, perfect thing to use. And then you've got to dive in sort of a second factor of, well, what is the right metric? What metric do you want to achieve as a buyer? What matters? Is it achieving some sort of operational goal? Maybe it's a pre-revenue company, a target. Is it achieving some stage of growth or some operational goal? Maybe it's purely financial. Maybe it's revenue growth. Maybe it's an earnings base. But what is you've got a use case for it, and now what metric do you need to pair with it to incentivize and drive the outcome that you want, right? And then at that point, right, you've made a decision to use an earnout because it's solving a real problem, and you've appropriately and tailored the earnout metric to solve that problem. And then it's doing the things that Pat and I walked through in the slides in terms of what are the key negotiating points and how can you document and try and reduce the friction or the likelihood of dispute on the earnout metric that's chosen. And so that tends to be the way I would kind of run through the factors with a client on that type of question.
Perfect. Thanks, Will. Looks like we're out of time here. If you asked a question and we didn't get to it, either Will or I will reach out directly following the program. So thanks for joining, everyone. It looks like you're now headed to a break, and then after the break, you'll hear from Amish Patel and Meredith Haynes on supply chain disputes. I think that starts at 10:20. So thanks for spending your Friday morning with Will and I, and hope you guys have a great day.